Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh.
Welcome to Wealth Matters podcast. I am going to talk to my neighbor today, Drew Wahlgren. It's funny, Drew and I started connecting and I didn't realize both of us live in the same town. Of course, I'm not going to talk where we live, but it's very funny. So we are planning to meet, one of those days. But Drew is a director of capital markets, and we want to talk about triple net lease properties. Let me introduce Drew in the meantime, though. He worked as a risk analyst at Liberty Mutual Insurance, and then he decided to leave the corporate world to jump into commercial real estate. He has a BS in finance degree from CSU at Hayward. So you can tell, of course, he's in Bay Area. And he is focused on triple net lease so much, and I want to learn more about it as well. So welcome, Drew.
Thanks for having me, Alpesh. Great to be here. Fun to be with a local. I could probably hit a golf ball onto your lawn with a 5-iron from here.
Yeah, you are by the golf course. I know.
That's true. Exactly. But no, great to be here and talk about this stuff. And, before I left the corporate world, I was investing as a passive investor, like probably a lot of your audience. So really was doing that for a long time and joined one of my sort of sponsor who really I just became very close with and it was just a great fit. So I've been over at Mac Capital Partners as a director of capital markets for the last a little over 2 years, 2.5 years or so, just working with the lenders on the acquisition side and also our private investors on the equity side as well.
Awesome. So the first question we always ask, tell us something interesting or funny about yourself.
Something interesting. Okay, a little kind of off the wall. Here's something kind of odd. 9/11 happened and I actually was on one of those flights. It was JFK to SFO, right?
Yes.
Here in the Bay Area. And the same airline, same flight number, everything. Basically, the day before the morning of 9/11, I was on that flight back and I came back and some of my friends said, I thought you were on that flight. You said you were, coming out of JFK, flying back home. And I got my days mixed up. We thought you were on that flight. And I didn't even realize it. I look back, I'm like, wow, I guess I left a day early. So thank God for that.
You were lucky. Yeah.
That's just the first thing that came to mind.
I had mentioned about this as well before. So I used to live in New Jersey at that time. And that happened on some Tuesday. And I was on top of the World Trade Center on Sunday night.
Wow. Wow. Yeah.
That was a concert and we were there.
Yeah.
And I'm like, we finished the concert and this thing happens on Tuesday. And I was like, woo, we were there literally on Sunday.
Yeah.
On top of the building.
Similar situation. I wasn't on top of the building, but yes, I was right down in Manhattan, probably a day or two before I left and, looking right at the tower. So it was surreal. And then of course to find out that, hey, you just got off a plane right before, basically all flights got shut down for, gosh, I don't even remember now, like a week it felt like. Interesting times. And I guess cheers to good timing, right?
Yes. No, that was one of the worst time I have had. So I can remember pretty clearly.
Sure.
So how did you get started in real estate? What was your very first investment other than your primary residence?
Yeah, I mean, that was my first, but it kind of taught me the power of real estate. I certainly bought at the very bottom, early 2011, the market was probably about the bottom. And I bought my first house then and for very little money down. And it was a fixer upper. So I've never been a flipper, but, I'm a guy who's comfortable with tools and comfortable doing some DIY stuff. And I just wanted to have a nicer house to live in, really. Ended up doing a lot of work on it. When I sold, made an exceptional, at least in my eyes at that time, I thought, wow, I can't believe, obviously the market came up, but I added a lot of value to this property too. And sold, and I just had more than enough in proceeds to, move into something a little bit nicer, a little bit bigger. But I had a lot of extra, and I said, okay, what do I want to do here? And those are kind of a crossroads for myself. Do I want to become this active investor? Do I want to manage rental homes or put this into, buy a multifamily property, a 3 or 4 plex? what do I want to do here? And I really chose to go in the passive direction, and I'm glad I did, just for myself, because I had a W-2 job. I was being shown a lot of opportunities at that time in a large corporation. But as much as I'm glad I'm not in that world at the time, I got a lot of opportunities, and I didn't want to take my foot off the gas. I thought, you know what, I'm going up the chain, moving up the corporate ladder, if you will. And I said, I want to keep my focus here. So I went passive, and I invested with a handful of sponsors around me here, and, really enjoyed the experience and learning. And it certainly helped that my brother actually worked for one of those sponsors. So of course, immediate trust curve was met there.
Yes.
No problem putting money with him and the sponsor team that he was with. But then really he started introducing me to other sponsors. So, and now it's like, okay, now I'm going through that process, evaluating a sponsor, evaluating the deal from a really objective place, and you don't have that trust curve yet. So really enjoy the process, getting to know people, getting to know just the incentives behind, the structures around syndications, if you will, and what sponsors are looking to achieve, and how fair that their structure is and returns to investors versus the sponsor. Just enjoyed the whole thing. And so from there, I jumped over to Mag Capital Partners after having invested with them. And now I'm here enjoying being with them. So
that's great.
That's kind of the journey.
So let's talk about, because you guys focus on triple net, or sometimes we'll see it as NNN. And I have also seen NN, double net. So what is a triple net lease?
So triple net means that you're putting responsibilities that are typically on a landlord on the tenants. So generally when people talk about net, the three nets they're talking about are property taxes, insurance, and utilities. We do it's called an absolute net lease. I mean, we're talking about including more than just those items. So,
oh, really? Okay.
Yes, absolutely. So you can structure a lease any way you want, right? So it's triple net is just kind of a broad term, but essentially means that you're not paying for expenses month to month. However, it might not include maintenance and roof and structure, for instance, right? Hey, the roof needs a $100,000 repair. Well, that part's not on the tenant. So we structure an absolute net lease, which means that, hey, the tenant, you are going to be responsible for roof and structure, all the maintenance. We have virtually no responsibilities there. So it's a very passive investment for a landlord. You don't have to worry about those expenses eating away your cash flow, because, I think for anyone who's invested a bit, you go, hey, I have some reserves here. I have some reserves here for these things, but I've seen people get blindsided by large increases in property taxes, or, hey, you know what? We had an inspection of the property. We felt really good about it, but we missed something, right? Maybe there's a large expense and it comes and blindsides you there. And, there goes your cash flow for maybe 3 months, 6 months, 12 months.
Oh, yeah. Yeah. I have had that happen. We did the inspection, and after 6 months, we found a foundation issue. So not only the cash flow, it was, I think, couple of years worth of cash flow was gone. Right?
It's not hard for that to happen. Yeah. So with that triple net lease, you kind of remove a lot of that risk, right? That operational risk that comes there. So it's a very nice place to be. And, as you can imagine, your lease rate's going to change a little bit with that kind of term, right?
Yes.
The tenant's going to pay less generally from a gross lease to a triple net lease. And so there's a trade-off there, but generally there's in a single tenant world, and we're focused mostly on industrial real estate. In that single tenant industrial world, a triple net lease is really common. Yes. It just makes sense. It's very simple. And typically, a lot of our tenants have actually been in place and actually owned the property before we buy it in advance.
Oh.
So yeah, and we could talk about that in a minute here, but we do sale leasebacks. We purchase properties from commercial business who owns the property that they operate out of, and simultaneously lease it back to them. So in this case, they've already had that ownership role. They've already had responsibilities of taxes and maintenance and capital expenditure items. So they're pretty comfortable with it.
Where are all your properties? Where do you guys invest? Is it California,
we're a little agnostic.
Area? Or?
Yeah. No, we're a little agnostic. It really kind of depends. There's not a state that we say we won't do business here. It just needs to make more sense, right? I mean, there are additional fees and costs around property investments in, New York and California, of course. But if you find a great deal there, you're going to do it. We own a couple properties in California. We own a property in New York, but most of them are going to be Midwest, Texas, the Southeast. I mean, this is where, again, we're doing these sale leasebacks with a lot of manufacturing companies, food processors.
So Southeast and Texas right now, you can't go wrong.
Right. And they're going to set up shop somewhere there's a lower cost of labor.
Yeah.
There's a lower cost of overhead. Yeah, business friendly. Exactly. Yeah. So we don't find a lot of manufacturers outside of Tesla here in the Bay Area. So there's not a lot going on.
They want to move too, right? Elon wants to save on taxes.
Well, they moved their headquarters, but they left the manufacturing plant, which is kind of interesting.
Mostly a gimmick. That's just like, him trying to get out of all the California taxes. That's about it.
Sure. Yeah. Well, I just read they moved the headquarters, but they're actually increasing the manufacturing footprint in Fremont. So pretty interesting what's happening there. But it's obviously a productive, profitable plan for them. So outside of them, not much, here. And you would do the same thing. Hey, if I'm starting a company where I'm making parts for ATVs, let's just say, and I'm shipping these parts out maybe nationally or globally, why would I set up shop here? It's got to get sent out anyway, right? So I'm going to go set up shop somewhere where I can pay a fairly low wage in relative to California, let's say. However, that wage to my employees is still going to be enough to provide a single source of income for a whole household. And that's, we talk to these tenants and that's how it goes there. You think, oh, these wages are really low until you realize the cost of living is wildly low. So
huge difference.
Yeah.
No, that's awesome. So now let's talk about how do you invest in a single tenant, triple net lease industrial properties, right? What exactly do you do?
Yeah, I think the sale leaseback, I want to jump into that some more because that's a big part of what we're doing. We look for sale leasebacks because really it's a fantastic investment vehicle. We're able to craft and execute a brand new triple net lease with a seller who's now becoming our tenant, right? They're selling their property and they're leasing it back from us simultaneously. And for the seller, it's a financing instrument. They're looking to access capital to grow their business. So, all of us real estate investors were like, why would anyone want to sell their property?
I was actually going to ask you that what are the main reasons other than, of course, they want to grow their business.
Yeah, from an individual standpoint, anyone who's read Rich Dad, Poor Dad for the last 20 years, right? They go, hey, you should own cash flowing assets, but they have different motivations. And there's a huge opportunity cost for a commercial business like this. They go, look, I can use this $10 million that's tied up in this real estate to grow this company by 3x, right? Why would I continue to hold here? And they do have IRR calculations. CFOs do this on a regular basis where they're comparing what their return is on this capital. And pretty frequently they're finding, hey, this is a really good financing instrument for us. And sometimes there's other motivations. Hey, we have some debt already on our balance sheet, and maybe those debts have some covenants that say they can't take additional debt on. So when they do a sale leaseback, the proceeds that they get there, they don't go onto the liability sheet again. Yes. So now they have a lot of freedom around that cash flow. They're paying rent that's tax deductible. And there is some sheltering from volatility in the rent market. Hey, I'm signing a 15 or 20 year lease with 2% annual bumps. That will certainly shelter a company from wild swings or maybe even inflation.
Yeah, that's less than 2% inflation, targeted inflation, right?
Exactly. So for them, that's what that means. And for us, the benefit here is, again, we get to craft a really institutional grade lease long-term and be at the front end of that lease. And really, we have instant day one cash flow. And that's why, a lot of folks partner with us to bring their capital alongside us, because they're going, hey, there's not a lot of opportunities I find where there's really stabilized day one cash flow. Usually I have to wait for some time and to do some work. We got to increase rents at a multifamily property, or we need to lease up some spots at a mobile home park. There's some work to be done to create that value. So what we do is really stabilized investment. And, this is about 80% of what we do. We do some value adds, some blend and extend, some small developments on the side as well. But these sale leasebacks on, triple net lease and single tenant industrial properties, that's the bread and butter of what we do. And we have that momentum and a lot of the broker relationships to continuously find new opportunities.
So I have some questions. So how and where do you find these sale leasebacks?
So I'd say number one is probably the brokerage community. If you go to the major brokerage houses, JLL, CBRE, these guys have multiple teams that work on different things. And, anyone who specializes in sale leasebacks, they know who we are. We know who they are. It's a very small niche of the whole real estate market. So, it helps to have some kind of a reputation there. But also, a lot of these opportunities come from the private equity world, actually. They are purchasing an operating company, and oftentimes it comes with the real estate. Now, they don't want to tie up their money into real estate. So they want to instantly or shortly thereafter spin off the real estate in a sale leaseback. So that's a way for them to keep their acquisition, the basis of that acquisition, very low. So, it might be a $20 million acquisition, but 10 million of that is real estate. So they certainly don't want to tie up $20 million. Hey, let's spin off the real estate. We'll have a nice, favorable lease that works for us, that this company can support, of course. And now we're the benefit of that transaction, right? We're able to have a private equity backed business that has very strong credit, and we can, enjoy a lot of the security and the cash flow that comes from that, with the tax benefits, of course, too.
Okay, no, that's great. And how do you usually work it out with the owner of the business? Well, what kind of due diligence you perform, and then how do you work it out where it's, of course, it has to be a win-win, because in this case, right?
Exactly. So it's, every seller's got different motivations. They have different needs. And that I really enjoy this part, right? Kind of just talking to a seller and going, okay, what is it you're looking for? What's the objective here? And it could be a number of different things. It can be as boring as, hey, we just want to strengthen our balance sheet. We have some debt, maybe we're 3x levered right now, which is certainly not over levered. That's, that's kind of a healthy middle ground or so, but they just want to strengthen their balance sheet. And maybe that will help them get favorable financing terms in the future when they see an opportunity. So they're just looking to delever, or someone else may say, hey, we're looking to use these proceeds to invest in new equipment. We're going to launch a new product line. But at the end of the day, you have a growth or strengthening of the credit of this tenant, which is nice for us, right? When you're the landlord, that's what you're looking for. And I'll jump into that because that's part of your question is, what are we looking for? And in that sale leaseback with a triple net lease that's really long-term, there's really no operational risk. All the risk lies in this tenant. Are they solvent, and will they be paying rent for the time you hold the property? So that's where we really zoom in on is the creditworthiness of the tenant. We've learned from the publicly traded REITs, and we've actually hired a lot of their credit analysts. So we have an in-house credit analysis team, and they're institutional grade. I mean, these guys, they spend weeks, if not months, looking through the financials and interviewing the C-suite of the company and really just getting a feeling of who they are, where they're going, where they've been, looking at their balance sheet, look at the covenants around their customer concentrations, what kind of contractual relationships they have with suppliers and customers. All of that comes into account. So it's more than just, hey, I've looked at your income statement and it looks pretty good, I guess. It's far deeper than that. So we want to sleep really well at night, and we can if we really understand this. And it's not to say that there's no risk. It's just that we understand what the risk is and we can get comfortable with it.
So I have a couple more questions on focused on this. One is, what is your investment criteria? What do you look for, right? Does it have to be in an MSA, or is it submarket? Does it have to have this much cap rate? And so can you elaborate on that?
We're not that structured. It's going to, we don't have sort of set exact criteria, because I honestly believe that you lose opportunities by doing that. So you really need to look at the whole picture. And if something is sort of, it might be someone who's in an industry that doesn't look good. And I'm talking about the tenant here. And you go, hey, the whole structure of a sale leaseback and a long-term lease is here. But again, we're looking at this tenant and, they might be in the printing business, right? And you go, well, shoot, that's an industry that is showing overall weakness. But I'm not going to set that criteria that I'm never going to look at someone in that industry. We're going to go find out if maybe they're the exception. Hey, these guys are actually the strong players with great customer relationships in certain applications that they really specialize in and just do well, right? You have to look and see what you're talking about. So, I talked about geography. It's the same thing. Am I going to find a lot of great opportunities in California, a really high price market? Probably not, but no. I'm going to look at that opportunity and say, okay, what do we have here? What kind of cap rate can we get this for? And who is this tenant? And, it might be not a cash flow opportunity. It might be, hey, we're just going to get a screaming price on this thing and turn around and sell it in a year and make some nice money here. So you really have to look and dive into it. And that's a little bit of a problem though, too, because we see a lot of opportunities. We actually had a very long deal call as a team today, a little over 2 hours, where we were looking at all of the opportunities and, really starting to take some, put them in the trash can and take other ones and move them to the next step and, put together offers. And it's important to kind of be able to take a look though and realize, okay, we don't see legs here. We need to kind of push this one to the trash can. But, I like taking I think all of us as a team here at MAG, at least, really like taking a contrarian's look at a deal that maybe is getting overlooked, right? Investors are going in a different direction because of X, Y, or Z. Well, let's go look into that. Let's go ask questions. I'm reading a book right now by Sam Zell called, if you know Sam Zell, notable billionaire investor.
Mobile home park, right?
Yes.
You can't go wrong.
Right.
And
so
he's investing in cryptos now, by the way. So he's smart.
So he has a book called Am I Being Too Subtle? And he kind of talks about that. And it's a
great book.
Yeah, it resonates with me because he goes, look, everyone's going to run over here in this direction. Well, what's over there that everyone's staying away from? And what is that? Let me go understand that, because that's where he's finding opportunities. And so we're not afraid of doing that either. And I'll give an example. We looked at a sale leaseback earlier this year. It was a tenant who had filed bankruptcy 12 to 18 months before then. And it was Chapter 11 bankruptcy. They really just needed to convert a lot of debts and under the protection of the court to equity and really rebalance their financials, their balance sheet. So at the end of the day, you realize after doing a lot of digging and untangling the financials of a large global organization, you find that, hey, these guys are actually very de-levered at this point. They don't have that same debt. We have, throughout COVID, they didn't lose any customer relationships. And they have a great CEO in place that was changed right before bankruptcy, actually. So we have a lot of good things here. But if you just see a company that says, oh, they had a bankruptcy, far too risky, and you run the other direction, well, you're going to miss out on something that, and it was priced in a way to reflect that. So, my question for anyone who would look at this deal, say, imagine you fast forwarding 5 years, even if this company stayed perfectly flat, they didn't grow at all, which, as an equity investor into a company, that's not good. But as a landlord, that's perfectly fine, right? I just want a stable tenants. I don't need this company to grow. But even if they stay flat over the course of 5 years, now imagine that bankruptcy is 5-6 years behind you. What do you think this property will trade for now, right?
Right.
That perception of risk is the only thing that's really changed, when in fact they actually are in a strong position today. So that's, that perception of risk and where that risk really is where we find the arbitrage, and where that opportunity is. That delta between the two is where you find those opportunities.
Hey, so what kind of cap rates are you getting on this?
Today, everything is about 100, 150 basis points lower than they were, a year and a half ago.
Right.
But we typically, you could see anything, right? It depends on the tenant. You have a credit tenant, it's going to be at a 4% cap rate or something, maybe less than that. If it's Amazon in California, it's going to be a 3% cap rate.
Yeah, 3. Yeah.
Right. But we're in the private credit tenant world. These aren't publicly traded companies for the most part. They don't have that Moody's credit rating. So they'll trade anywhere from 6 to 8%. Again, a couple of years back, you could find even more deals in the kind of 8+% cap rate.
9, yeah.
Yeah. So there are opportunities there. There really is a supply-demand imbalance still in the industrial world. And that's continuing and really being exacerbated by supply chain issues after COVID. So it's a great place to be. And we didn't see COVID coming, of course, no one did. But it really we were in a good place when that happened, and our tenants were continue to operate. But the demand for industrial really, I don't know that there's ever been a better time to be.
Oh, yes. Yeah. This last year has been like crazy because on top of that, not only supply chain issues, but everyone started buying online, right? Amazon had to increase its presence. Same way, most of the stores also had to increase their presence. And a lot of stores, brick and mortar are closing, but they are going to operate online, right? So they are going to need that industrial space.
They're fortifying their supply chains, which means more distribution hubs. It means more warehousing. And, and honestly, we don't do a lot of third-party logistics types of properties. We are working with a lot of manufacturers and food processing companies. And
that's huge right now.
Yeah, absolutely. And a lot of those companies that are really global, they have, especially with operations in Southeast Asia, a lot of them are looking to onshore at least the critical parts of the organization, right? They go, hey, I have a lot of risk tied up in something that's really important to my organization. And maybe I can have some of the more commodity items produced overseas, but something that's, we can talk about semiconductors and chip shortages and all that. No, but those critical pieces, I need to have some control over.
Yes.
So you're seeing a lot of these things just driving the overall demand for industrial. There's going to be a supply-demand imbalance for a while.
Oh, that's awesome. So I have a question about now, I want you to take out your crystal ball and tell me, what does the next 5 years look like?
In general?
Yeah, I would say in triple net lease space as well as in real estate.
Well, I'll speak really specifically for us, and then I'll talk about the whole real estate space. In my crystal ball, I see us continuing to find more sale leasebacks. This is becoming, again, a financing instrument that's become more and more popular. And so us having that momentum and a reputation in that market, we're able to find more off-market or somewhat off-market deals because a seller needs to close. And again, they're going, I don't have time to screw around. I need to recapitalize or invest this equity that I have tied up, in 3 months from now. So I need someone who can execute. So Matt Capital Partners, okay, you have a reputation here. You can close, and I trust that I'm going to give you this deal. So I see us seeing more opportunities, and really the biggest risk for not only us, and I'll move a little bit more macro, and it's not a risk, it's just how things will swing is how interest rates change. I think we all see interest rates as probably starting to bump up over time, and hopefully it's a nice slow bump up. I think people are really seeing that it's going to be necessary to somewhat curb inflation. I mean, there's a lot of monetary policy that's being stirred up right now, and no one wants to be responsible on the capital though for putting a halt on growth of the economy. So that's the tough part, right? You think this is the right thing to do, but who wants to do that? Who wants to fall on the sword? The Democrats or the Republicans or one particular politician. So no one wants to do that.
It's better to keep printing.
Yeah, just keep printing,
easier, right?
Keep rates low. And to be honest, that might happen for a while. I mean, at least, I don't know about the printing side, but at least the rates, they may stay low for another 3-4 years. I mean, I think Goldman Sachs, this has been a while since I read this. They were predicting really no increases until 2024. So that was just one mind, and things have changed certainly since then, as they're seeing, every month it seems to be 5.5. We're getting close to 6% year over year inflation. Right. It's pretty crazy. So I think it's going to happen. And as long as it doesn't spike, I think we're going to be in good shape. But that I certainly could see it happening as a possibility, right? And if that happens, then, at that point, we're in a great position personally, or from a firm standpoint, because we have these long-term cash flowing properties with a single tenant and a long commitments, and they're going to operate throughout all these economic pullbacks, and they have for decades generally. So that would be our position there, is we would probably hold and cash flow, and maybe our acquisition rate would go down. It probably would, because the cost of capital. But
right.
And also, I don't know if I want to unload a property if there's less buyers and high interest rates, right? You're going to see lower sales price. So that spike in interest rates, if that happens, I think would be short-lived. But that's, I think, the biggest risk to the entire real estate market is what happens with this inflation, and how does the Fed decide to handle that with interest rates?
Oh, that's awesome. Let's take a quick break. And after the break, we'll go through the same questions I ask every guest.
Cool.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Drew threw some golden nuggets here about triple net properties, and I was actually mesmerized. I was listening to him, trying to understand how those sale leasebacks work, because that was pretty interesting, and especially having that with an absolute net lease property, that's like a win-win. So Drew, are you ready for fire round?
I have no idea what to expect. Be easy on me, but yeah, hit me.
Yeah. Would you be changing any business or investment strategy after this pandemic is over?
Wow, I don't think so. This strategy we've had since about late 2015 has treated us well. And I think this pandemic has been a good test of that thesis, and it's done really well. So we've kind of moved in this direction because we saw a very recession resilient space in the real estate market. So it all depends, but no plan changes.
That's awesome. Favorite real estate or finance or any other related book?
I mentioned the Sam Zell book I'm reading right now. I have on my desk. I thought an interesting book, and I'll show it to you right here. This is Next Up. I heard a pod. Oh, geez, I can't get it in here, but Risk, a user's guide by. It's pretty interesting. I mean, I haven't
heard of that book, so I'll look into it.
Yeah, it's written by General Stanley McChrystal and really talks about risk and just in all forms. And obviously, when you come from a military background, risk is a lot different than losing capital. Risk is losing lives.
Right, yes.
It's real stakes there. So who better to write a book like that? And him just coming from a general's perspective where they're taking risks where it's not his own life. It might be someone else's life. It's soldiers on the front line. Yes. And what is worth the risk, right? And what may be too risky and what's being a little bit too liberal with people's lives for a decision, for a reward, so I think it's fascinating.
Any tool or website you recommend, maybe to find triple net properties, or maybe you use it in your day-to-day business?
No, honestly, I'm not a guy where our team isn't scouring the MLS or anything like that. Or LoopNet or anything like that. We really work with relationships. And as far as tools, the good old Excel spreadsheet is our best friend. We're old school like that, but it works well. And we're constantly, underwriting new deals. And that's my comfortable space. So that's where I live.
Any advice for beginner investors?
Yeah, jump in. If you're looking and sort of don't get the paralysis by analysis, you need to look around, and if something makes sense on a surface level, jump in. Don't be afraid to have something not be perfect. I feel like there's so many people that are going like they're analyzing 3 markets and they're all they feel like the returns are all within 70 basis points of each other. And I'm like, what are you doing? Just pick one that you like or something. Which one of these cities would you like to visit the most? Maybe. How about that? Right? Find something, start there, jump in. It doesn't have to be a home run, right? Get in there, get that experience. And chances are you're not going to lose money in the long term. I mean, really look at real estate over decades and decades. And as long as you're not taking a very short-term risk, then generally you can ride any real estate investment out to a point where you're making money.
No, that's a great advice. And this is what I always mention. And let me tell you this, 150 plus episodes, 70% of the guests have always mentioned this. And I keep telling this to everyone. Don't be a tire kicker. Pull the trigger. Yeah. Take action. All of these are one and the same thing. Analysis paralysis, right? In the end, you can't wait for a blockbuster deal, right? You are going to miss out on a lot of other deals, which will help you get your feet wet. Maybe it will, you will experience things which you may not have experienced with that blockbuster deal, right? So there are I lost every penny in my very first real estate deal, but what it taught me has served me so well since 2015.
Yeah, and I go to meetup groups every week. I mean, all the time all around here in the Bay Area, and some virtually across the country. And I'm consistently meeting people who are going, hey, I'm new to this. And I've been researching it for over a year. And I'm like, wow, imagine what kind of returns you left out, especially in the last 12 months.
Last 18 months. It's been crazy.
Yeah, you might have made, you might have made 50% in equity, 100% in equity, if you had just not been looking at so many deals, wondering if it was the right one. So yeah, you have to jump in, and I hate to use the cliches, but feels a little bit like it's time in the market, not timing the market, because that's a fool's errand. So keep that in mind for all those new folks out there. Just jump in.
It's awesome. How do you give back?
I love spending time with said new investors. I just spent an hour and a half with a guy who's just about to graduate college in Tennessee. We met at the Bigger Pockets conference in New Orleans, and he was just fascinated by what we do, and he just wanted to learn more. And I will always give my time to folks that want to learn and do better. And I meet a lot of folks where, that happens. And then a year or two later, hey, they bought 4 properties, and not because of me, but just because they're driven and they go out there and do it. And I always tell them, I go, look, get some experience under your belt. And I'm, if what you're telling me makes sense, which a lot of times what they want to do, and it makes sense to me, I say, show me a deal after you get a couple under your belt, and I'll invest my own money with you. As long as it makes sense here and you get a little bit of experience under your belt, I'm happy to join you and, and kind of support you because we're all in this together. And maybe I can lend some kind of little gem of wisdom. Maybe I don't have lots of those, but maybe there's something I can bring to this deal to kind of help us, partner together on this thing. So that's a way I love to kind of help support people as they come up.
Oh, that's great. How can my listeners reach out to you?
They can email me if they'd like, Drew, D-R-E-W, at magcp.com. That's magcp.com. They can even go to our website. They just want to reach out and, register on our site, and we'll usually set up a call after that. But magcp.com, you can go there and check us out as a firm. And again, just happy to chat with people if they want to ask questions. But if they're interested in getting involved with kind of investments that we do, they can always reach out. We can talk.
That's awesome. Thank you so much, Drew, for your time.
Thanks, Alpesh. It was fun. It was, next time we'll do it in person. And if you want to have me back, we'll do like one of these live, man on the street interviews or something, walking around San Ramon. I mean, I already gave it up.
Yeah, that's fine. That's good. No, thank you.
All right. Thanks, Alpesh.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!